Okay, so some of us already know or have some little history about how we got here. Some of us know about you know the the gold standard system when currencies used to be backed with gold, when there was no need for even anything trading because the exchange difference between currencies were not so much. All right, I'm talking about after the Second World War when we had the Bretton Woods Accord. I'm going to be using Google, to kind of show some of these things so that you can check it out at your own time. All right. So we're going to be looking at briefly the Bretton Woods Accord. These are very important times when it comes to the world's financial system. After the Second World War, a whole lot of the entire world's financial structure was kind of destabilized. So America happened to be one of the strongest economy because they built most of the machineries used in fighting, this war against Hitler. Some of us already know that, but this meeting was a very, very decisive meeting where world leaders actually came together and then decided how the world's financial system is going to be run. So they agreed on a couple of things here, which I'm not going to mention everything, but they came to an agreement here that, the world's currency is going to be backed with gold in order to reduce, the level of fluctuation, okay, in exchange rates of different currencies. Because after the introduction of before the war started, the World War One and the World War Two, there was a whole lot of inflation, hyperinflation in various parts of the world because people were, printing excess of the paper notes, all right, which is partly exactly what is being done today. So this led to, because most countries were in wars and they needed to pay for their war treaty and buy weapons and all this stuff. So a whole lot of stuff happened. Different nations were printing excess paper which actually devalued their currency at that time. That was why when the war was over, this meeting was held in 1946 in Bretton Woods. So this was when every currency of the world was backed with gold. But something happened 30 years later after this meeting. When that happened, after this meeting, there was some amount of stability in the world's financial system because every currency in the world was backed with gold. And most countries could not print paper notes without having the same amount of gold to back it up. So there was some atom of stability. But you see, it didn't actually favor every country, okay, especially the United States. So something happened in 1971. Fast forward 30 years later, Richard Nixon came on board. We'll call it the Nixon shock. It's another second event. Okay. So whenever you're looking at the financial world, you don't ignore the Bretton Woods Accord and the Nixon shock. The Nixon shock came in 1971. This president came in 1971, and when he saw that a whole lot of gold was leaving the United States, and that much of the dollar notes were coming back to the US, coupled with the excess dollar bills, which are already printed without being backed by nothing. So it foresaw a kind of a total collapse of the US economy. So in order to avoid that, he quickly canceled what we call the gold standard system. All right. Part of the deal, part of the agreements they had in Bretton Woods, he quickly canceled it. And since that time, currencies were allowed to float. All right. And a lot of things happened at that time as well, like the introduction of the petrodollar and all those stuff. We're not going to be talking about all that. We discuss in depth in our training program, okay? But this is more like a very brief session. So after Nixon made that statement, everything changed in the world's financial system. So some of the problems that we've had in the financial system, the fiat financial system, got very worse from 1971 up to date. I'm talking about the high level of inflation, high level of devaluation of paper currency, which you know as fiat currency. Okay, so this news by Nixon brought the world into what we call the floating system. All right, so the floating financial system. So the floating financial system, I don't know how Google puts it. I've not come here before, but that was what brought about things like this, You see various currency, fluctuating based on demand and supply. So what Nixon actually did was saying instead of currencies to be backed by gold, which will give it some amount of value, let us unpeg the gold in every currency and let it float. Let the value of demand and supply of each currency determine their value at the time. So what this did was that it brought about large difference in exchange rates between different countries' currencies, and that's what brought about trading. Okay, so trading started. People can speculate, and they can speculate what exchange rate a particular country's currency would be with that of another country's currency after that happened. So that is where we find ourselves today. And fast forward to 2008, when the great Ponzi scheme, the great Fiat Ponzi scheme, some of us knew, happened, which is the world's the global financial crisis. It's a Ponzi scheme because, like some of us know about Ponzi's, one bad thing about Ponzi scheme is whenever there's the system might be going fine, people might be earning money, but once there's a bad news, and people stop putting in money, what happens? Everything begins to crash. Withdrawals begin to get suspended, and a whole lot begin to happen. So that's exactly what happened in 2008. The entire system, from the Federal Reserve to the commercial banks, some of us already know the structure, the world fiat structure. All right. Sorry to say, it is a legalized Ponzi scheme, right from the Federal Reserve to the Treasury to the central banks across the world, and how our notes, the paper notes, are being printed. So Lehman Brothers came out in 2008 and made a statement that if they don't get support, if they don't get any financial support, they're going to be, they'll go bankrupt. So Lehman Brothers happened to be one of the oldest banks that even survived the Great Depression. All right, Lehman Brothers have been here for centuries. So for Lehman Brothers being one of the strongest and the oldest banks to make an announcement that they could file for bankruptcy, that created a lot of panic, just like a regular Ponzi system. All right. So a lot of money stopped moving into the institutions because of what Lehman Brothers said. So it became very open that most banks were actually broke. So that was what happened in 2008. So a whole lot happened. People lost a lot. So that was what brought about the entire uh, cryptocurrency system. A system whereby we can have a financial method that is not controlled by some people. A system where everybody on the network can actually contribute on how a transaction is being processed. Okay, so when that happened, you know, here we are today trading the cryptocurrency space the same way we trade the forex market. Before it came, some of us might have been trading the forex market, before cryptocurrency market came. But if you are in that position, if you're one of those who have been trading the forex market before the cryptocurrency market, you shouldn't be having much problem with spot trading. But some of us are totally new about spot trading. Well, for some of us that are new, that's why we're taking time to discuss some of these things. Okay, so now when you look at that brief history that I just made, you see it gives you a trend of how far the world has come. All right. So with that being said, I'm going to move into the next topic we're going to talk about. Okay, remember this is going to be brief as much as possible, because in the actual training we actually go more in depth. Okay, but this is more of an introductory session into spot trading. So we look at the techniques of spot trading. Now, haven't told us what brought about spot trading. Some of us, when we hear spot trading is just one of those kind of trading that we have. All right. For example, when you go to Binance, for instance, we have different kind of trading. We have futures trading. We have leverage. We have a whole lot of them. You can see some of them here. Derivatives, you can trade leverage tokens. There's a whole lot of market you can trade here. Okay, but spot trading is just one of those trading. It's more like an instant, buying and selling. Okay, spot. All right, you just buy and you sell. So you're not trading it the way you're trading forex. In forex, you buy and you hope it goes into your direction. In forex, you speculate. Okay, here too you speculate in a way, but it's spot because the orders are closed immediately. Okay, so what are the techniques? Some of the techniques you need to be able to do this. And before I talk about techniques, well, I believe based on the way the crypto market is, the crypto market as well is not devoid of fluctuations. And the reason is because for every digital market that you see, fluctuation is very, very is very much part of it because different people at different times make different decisions. Okay. So we're going to be looking at some of the techniques that will help us as crypto traders, as people who have come to accept the new normal, which is the crypto market, how you can be safe. Because you see, look at what happened yesterday with Ethereum. Some of us, you see how far Ethereum dropped. Ethereum dipped all the way from 2045 down to almost $1,359, and now it's just picking up. But the truth is that if you understand spot trading, you know, you might not avoid this 100%, but you can avoid it 80, 85% if you understand the trick in this. And the good thing is that you can always get out of the market quick and buy low because those who control the market movements with billions and billions of dollars, what they do is that they just cash out on their profits, they push the market down, and they buy low again. That is why when you're trading the crypto space, patience is key. If you're not a patient person, just avoid the crypto space. You're gonna be losing all the time. Those who make money in the crypto space are those who learn to hold and hold properly. So in the crypto space, we use the term that history will always repeat itself. Why? If a market hits an all-time high, we're going to be talking about some things in depth, but let me just follow it. Let me just follow it this way. Let's talk about candlestick application. All right, to market trends. Some of us who already have knowledge of the market, maybe we've been trading forex or options, or maybe stocks. You already know what candlestick is. Candlestick is just one of these methods developed very many centuries, many many decades ago by Japanese, okay, to help us analyze the market price direction. Because since what happened, since market, since the price of currencies became speculative, all right, there was need to have a way to actually, know what direction a particular price line is going. Okay, so the candlestick, which you see, just like this, you see, this is a good example of a candle. Okay, we have the bullish and the bearish candle. Okay, now how can you properly apply this in spot trading? But before I talk about that, let me show you guys. We have various, like almost about 3 to 4 different ways that you can analyze the market, but most traders actually prefer the candlestick because of its simplicity. Okay, so we have other forms, other ways to actually analyze the market. We have the line chart, the bar chart. Okay, I would have showed you that here, but I don't know if I'm actually using Binance now. I don't know if they have some of those features here, but all the same, some of us already know that. But how can we apply candlestick when we're spot trading? Candlestick is best in terms of not just for trading, but when you're trading any digital assets. The reason is because the candlestick is the only market, is the only market analyzer that shows you almost everything that happens at every point in time in every market. Okay, so every digital asset that you open, you would always see, the time frames. Sometimes it begins from 1 minute. You can see it here. You have 1 minute, you have 3 minutes, you have 5 minutes, all the way to 1 month. Okay, which is going to show you the exact market direction for 1 month. So all these things are very important. So what the candlestick does is that candlestick shows you, sorry, somebody sent something on the chat. Okay, she said I can, good. So the candlestick kind of shows you the opening price of the market at every point in time, depending on the time frame that you're trading on. If you're trading on the 1 hour time frame, when I talk about time frame, for some of us who are new to this, that's why we need to kind of break it down and not assume that so many people already know. Okay, these are what we call time frames. Time frames simply indicates the time of the market. All right, the time it takes for each of these candles to form. For instance, now we are on the 4H, simply means the 4-hour time frame. So each of those candles that you're seeing here actually takes 4 hours to complete their formation. So the candlestick shows you the opening price of the market. For instance, this bullish trend, for instance, you can see here. Let me get this out so that we can see properly. Just a minute. Okay. So here is a bullish candle, right? Now you can see this is where the price opened for this candle at about 1,456 US dollars, and it pushed down, all right, to 1,429. Okay, that is the lowest price, all right, and then it takes off again up to this point, which we are not yet sure if it's going to be the highest price point because the 4-hour duration is not yet over. So until the 4-hour duration is over, then you can find the highest point and the closing point. And anywhere, any particular price line where this candle closes, as soon as the 4-hour time frame is complete, another candle will begin to breed immediately from it. Okay, so because of the way the candles are structured, you can tell where the market is going. All right, so when you're trading, the same thing happens if you're trading on the 1-hour time frame. Okay, so we're going to be looking at let's use a few minutes and kind of look at the candles for those of us who are new to candles. Okay, some of us already have some of this knowledge, but for those who are new, we're going to be very fast. Okay, now there are two main kind of candles. We have the bullish and the bearish candle. Okay, now the word bulls, the bulls, it was derived from the word bull. You know, the bull has its own on the upside, right? Some of us, let me go to Google and show you. Some of us know this, but some people just need to. This is the image of a bull, right? Image of a bull. They have their horns on the upside. Okay, good. You can see a bull, right? Now, here's the bull. Here's a typical bull. The horn is on the upside. And that's where we got the word bullish, the bulls, right? It means the upward pressure. Whenever you're trading, whenever you're spot trading, don't ever joke with the term pressure. You see, it's like a projectile, you know. The amount of pressure on the upside will determine how far up the market is going to go in price. And the amount of pressure on the downside will determine how far down the market is going to push. So when you meet a market that is falling that is falling like an asteroid, you should be able to tell, how far the market is going to fall based on the pressure at which it's coming. So those are some of the things the candlestick will help you understand. All right. You can just pay attention, very close attention to momentum. Momentum is very important when you're trading. Okay, so that's the image of a bull. So when you hear that the bulls are having the market, it simply means there's a whole lot of there's a lot of upward pressure on the market, because the market that you see is like a battlefield. The market is a battlefield between what? Buyers and sellers, because different people make different decisions. To some people, as we speak right now, to some people, it is time for them to buy Ethereum in big amounts, right? To some people, it's time for them to sell it. So based on these decisions, there's always a battle between the buyers and the sellers. So whenever there's more people buying a particular asset, whether it's Bitcoin or any asset, whenever there's more demand for it, okay, the price tends to do what? go up. So that price going up is a bullish trend. An example, if we go back, we can see something like this. Here is a typical example of a bullish trend. Okay, we can see what happened here. You can see what happened all the way from 1,490. You can see the upward force pushing it all the way down to 1,837. Okay, that is what we call the bullish. That is the bullish trend. So the bulls have had the market all the way from this particular level up to this point. Okay, so now whenever the market is pushing down, all right, or plunging, it means that those that are selling the market are more than those that are buying. Okay, so that is where we derive the word bearish. Okay, and also when you look at the image of a bear, okay, the image of a bear is kind of downwards. Okay, so bear is always bears represents, is it bear? Yeah, I think so. Bear represents the downward trend. Okay, so forget about this image. Let's go into the main market itself. So here is a bullish candle, an upward candle, because it opens at this point, finds the lowest price, and then moves up within the period of time, depending on the time frame that you're trading on, gets to the highest price, and then it closes. When it closes, the exact point when it closes, another candle is going to open. So what you want to do as a trader is to ask yourself, when this candle closes, what direction will the next candle go? Is it going to be bullish or is it going to be bearish? So your understanding of the candle will be able to help you determine how far the market is going to go, if it's going to be bullish or bearish. Okay. Now for a bearish candle, let's look at this again. For a bearish candle, as soon as this bullish candle closes, you can see a bearish candle opens here. And the first thing it does is you see some candles that will open and then move up. Let me show you an instance of a bearish candle. Now, here is a very good example of a bearish candle. Now, a bearish candle, let's take a look at this particular candle, right? The bearish candle opens up, it pretends as if it's going up, and all of a sudden, it begins to change direction downwards. So that's how bearish candle forms. First of all, they open and they pretend like they are going up to find the highest price at that time. Before you know it, it's coming down to locate the lowest price and the closing price. So wherever it closes is where the next candle will pick up from. Okay. But for bullish candles like this one that is just opening now, it opens, moves downwards as if it's, as if it's going to sell or go down. And all of a sudden, it starts going back up. This candle, for instance, is yet to find, you can see this is the lowest price of this candle right now at this point in time. This candle has actually opened here where this one closed. This candle opened, find it has just pushed down as if it was trying to go back down. Okay. And now it's going up to find the highest point. Between now and the next 1 hour from now, this particular candle will be complete. So then we'll be able to see the highest price and the lowest price. But I can assure you, when you see candles like this is a candle that's going to end bullish. Why? Because it has already given us the first signs of a bullish candle. So you need to understand how the bullish candle and a bearish candle forms. So as a trader, when you come into the market, for instance, and you see this kind of candle, what does it tell you? You see a candle that opened like this, pushed down, and now it's trying to find the highest point. So you already have that knowledge that this candle is going to end up being what? Being bullish. But why is it that there's so much pressure on the candle that it seems as if it's struggling to go up? The reason is simple. The reason is because the downward force, all right, the bears, okay, the downward pressure is so high on it that it's striving to actually, break forth. It's like a resistance, okay? So the pressure is much because when you come to the 1 day time frame, you can see that this candle here is red. Okay, it's bearish. And the 1 day time frame controls everything from 1 day down to 1 minute. Everything that happens to a candle in a day is determined by the movement of the 1 day candle. So every professional trader, when you open your market, the first thing you want to look at is your 1 day time frame. You need to understand, if you can figure out, for instance, what happened yesterday. Now, if you're a good trader and with looking at the way this candle closed, the previous day candle are closed, and this candle opens up, and you see it went up a little bit as if it was going up. Once you see that it's coming down, it is time to get out of the market. So if you are a good spot trader, you would have avoided this red candle down here. So what you'll be doing now is to be waiting patiently for the best time to plug in, which would have been at this point at 1,264, because we know that by the time this candle finishes today, the next candle that is going to come is going to pretend as if it's coming down and then go back up. So we might be seeing 1,750 or thereabout. If it breaks this resistance, then we're going back up to $1,900. This can happen before this time tomorrow or before the end, or this can happen like 24 hours, 12 to 24 hours from now. So if you are a good spot trader, you should have avoided this just by seeing how this candle started, because we know that once the candle is bearish from the 1 day, everything is going to be affected down to the 1 minute. Everything that's going to happen that day is going to follow the direction of the 1 day candle. So what do? You hedge. You can hedge in many ways. You can convert your money to USDC, to Binance dollar, or to USDT, and just hold it in dollars, which you can also buy back when the price goes very low. So that is the only way you can stay safe in the crypto space. All right. So that is how you can apply the candles when it comes to spot trading. Don't forget, well, if I'm to go in depth, if I'm to go more in depth, we can spend the whole day here. All right. So I'll try as much as possible to just, you know, just touch the topics. Okay. But that is how the market works. So everyone here, if you understood what we just did now, you should be out of this market exactly at this point yesterday. Because looking at this market, I'm going to come to the reason why you should be out of this market from here. You shouldn't be in the market while it drops all the way down, even though it's going to go back up, because the crypto space is always like that. It's going to go back up, even up to 1,900, 1,870 something. Yes, it's going to go back, but you should have avoided this if you understand how to apply the candles, if you understand how to look at the candle movement. All right. So just looking at the 1 day clearly shows you that this candle, as soon as it started forming, it's going to be red all down. So what do? You just hedge, just stay away in the meantime, right? While you use your 1 hour time frame to look at the best possible time to plug in, which is here. All right. So that's how it works. This is what the market does every single day. Every single day. The same thing it does every single day. So you can actually manage your funds by yourself just by taking advantage of the ups and the downs in this market. Because so long as the crypto space exists, there's always going to be ups and downs in the market, even though we know that by virtue of demand and supply, the general trend of the crypto market is bullish, which means even if you don't want to spot trade and you buy your coin and you're willing to leave it for years, you're still going to be in profit because the demand is growing. And the crypto space is actually beating everything in the financial space, especially in the fiat space. Most of us are, a lot of people are beginning to understand so many things about how the fiat system is being run. Okay. And they are beginning to look for a better option. And crypto is one of the better options for many people. All right. Some people have their fiat stock in many banks for years without no meaningful profit, while Bitcoin has done thousands of profits within a decade. So people are beginning to change. People are beginning to come into the space. So by virtue of that awareness, growing, the general trend in the crypto space is bullish. But if you want to make more in this space, if you want to stay more happy in this space, you need to learn how to spot trade. You need to learn when to leave, when to stay away from the trend, because there's always gonna be uptrend and downtrend. So as a spot trader, you want to take advantage of only the uptrends. You're not interested in the downtrend, except you want to do margin trading, or you want to trade it like the way we trade Forex, where you use your take profit and your stop loss. I teach people how to do that, but I really don't encourage newbies to do that because it's highly volatile. When you're using stop loss for something like crypto trading, it's highly, highly volatile. And if you're not careful, you can wipe out all your funds. Meanwhile, the crypto space is a space where you're buying an asset that you know that has value. All you need to know is know the asset that you're buying, know the success attached to the project. It doesn't matter how long it takes. That was why people who bought Bitcoin in 2010, even when there was a whole lot of uncertainty, that was how it was a faith in the project. It was a faith in the crypto space that made them held it even up till now. Okay, so the best way to the best way to go around the crypto space as a newbie, is to stay in the spot trading level. Just buy the ups, take advantage of the ups, get out when you need to get out, let it drop. It's definitely going to drop, especially when market hits an all-time high. That's a very wrong time to buy. Never buy a coin when it hits an all-time high. Your adrenaline, your emotions will be telling you, man, plug in, buy and buy. Don't buy. Wait. Wait and see what the market is trying to do. Okay. So if you wait, you will discover that the market is going to get to a peak and then it will drop. When it drops, then people have started selling. I'm going to show you guys something briefly. Let me just follow that topic so I don't get to deviate, because this topics are actually broad, but I'm trying as much as possible to just follow it. But I believe we've learned something about the candles, the candlestick application to market trend. Please, if you finish any of the points, if you learned something, you just type on the chat box. Okay. If you have a question too, just type it on the chat box, because we're going to answer one or two questions before we round up. All right. So based on candlestick application to the market trend, I believe we've learned one or two things, right? Which you can apply: the bullish and the bearish candle, and how you can watch it. For instance, based on my experience, I can tell you that this particular candle you see here right now is a bullish candle. It's going to go up. Okay, even though if you look at it closely, you would see that there is still a lot of pressure on the downside, because the bears still has the market. The bear still has the market, because the higher time frames are actually pushing it down. It's just like 1 hour time frame, for instance, to 4 hour time frame. Let me show you guys something. Check the 4 hour time frame. You see now, 4 hour time frame, for instance, and 1 hour time frame. What it means is that you have let's put a bag of cement, for instance. You have 4 bags of cement, okay, being dropped on 1 bag of cement. So this 1 bag of cement is trying its possible best to carry the 4 bags. So that is what you're seeing on the 1 hour time frame. A market that is actually going up, but it's kind of struggling, because the higher time frames are still saying the market is down, it's still going down. Okay, so now the story changes when the higher time frame, like the 4 hour time frame, you can see the 4 hour time frame is also bullish. Now let's look at the 6 hour. The 6 hour is bullish, right? Look at the 8 hour. The 8 hour is still bearish. So what it means is that the 8 hour time frame, which is higher than the 6 hour and the 4 hour, is still bullish, even though it's trying to change its position to bullish. It's still bearish. It's still a red candle. So you're going to see more moves when the next 8 hour candle forms. And this, because now the upward pressure, I mean the bulls right now, the bull strength has been able to pull this market all the way from 1,355 up to 1,553 right now. The bull pressure is actually taking over the downward pressure, which means more people have started buying the low, the dip, as we call it. More people are buying Ethereum right now. So, but it will take the completion of this 8-hour candle. Now, once this 8-hour candle is complete, one thing is going to happen. One or two things will happen. It is either before the completion of this candle, we might see a bullish candle, which is resting on top of this bridge. Can everybody see this bridge? Here, it is a bridge. So when you're trading, when you're spot trading, you must identify bridges. And can you see this bridge, this line? Can everybody see this line? If you can see it, just type on the chat box, because this line is very important. So good. I can see some people typing. Okay, great. Okay. Okay, great. Yeah, okay, we're gonna look at that. Now, this bridge that you're seeing here, one thing is gonna happen. By the time this candle completes, what happens is that if this candle completes by closing on top of this bridge, okay, it will, by breaking it off and changing to green on top of this bridge, then forget it. The next one that will come in is going to find its way all the way up. But if at the end of this 8-hour, this candle closes below this bridge, another candle is going to form, which is going to test the bridge to see how rigid it is. If it breaks it through, it will go up. If it struggles with that bridge, then the downtrend is still going to continue. But that is still a bit in depth. Okay. So someone said, okay. Someone said, can you please show us a sample of how spot trading works? Thank you. Good. So now, like I said, spot trading is more of instant buying and selling. Okay. So, but before I do that, that's a question I'm going to answer briefly when I finish. But for some other people, they need to understand some of these simple concepts. All right. So let's move to the next point. I think I've made more points on candlesticks application. Okay, we do more in depth in our subsequent sessions. So let's look at the Dow theory application in spot trading. Now, Dow theory is just a theory that helps us when we're spot trading. Okay, Dow theory simply explains the fact that different people make different market decisions. For instance, what happened in Ethereum here at this top here? The reason why you see the correction on Ethereum is simply because the Ethereum has gotten to the tip. This tip is normally regarded as Elliot wave 5. This is wave 5. Okay. Whenever market gets to wave 5, there's always going to be a correction back to where the actual trend started. Okay. So when you're looking at a market, when you notice that a market, when you're looking at a bullish market, it is always very important to look at how far the market started. Always count the waves. Very, very important. Count the waves. Okay. Now, when you see a long bullish trend, sometimes you may not see. Let me show you something about Elliot wave briefly on Google. Let's see. This is Google Elliot wave. Okay, so this is Elliot wave principle. This image actually simplifies almost everything that happens in the market. All right. Yes, this image. Okay, so this shows us virtually everything that we see in the market. Sometimes it doesn't appear so clear, but it shows us everything that happens. For instance, if you look at what happened in Ethereum here, take a look at this again, from wave 1 to wave 2 to wave 3 to wave 4, down to wave 5. Then we have the A, B, and C. Currently now, what we saw in Ethereum as the crash or the plunge is between B and C. I'm talking about this. Okay, if you look at this trend properly, you will see that you can see B here clearly. Okay, A at the tip. All right, A, B, and C. C is down here. This is what happened. So this from here to here is the fifth wave. This is our A. B is the point B is a very tempting point. B is the point where the market behaves as if it's still going up. Always be very careful. Okay, so when you see a long bullish trend, always watch out for wave 5, especially when you see a retracement like this. Just remember this. Okay, when you see the long trend, there's always going to be a retracement, and you see the market pretend as if it's going back up. At that point, you must become suspicious. Some traders at this point, what they simply do is that they just wait and see if this trend is going to come back it's going to catch up with this top, because this becomes a what? A top. Okay. So if the market, after struggling for hours, does not catch up with this level, they simply know that the long bearish candle is coming. So they just stay away. But the best thing to do is whenever you see a long bullish trend, always know that there will be a retracement. And that is why it is absolutely wrong for you to buy at, at the tip of every all-time high. Whenever a market is pushing up, especially to where the market has not gone before, that's not the best time to buy. If you are in the market, know the best time to leave. When you see that the market has gotten to that point where it's no longer going up and some funny things have, the market have started changing. For instance, when the market got to this level and retraced and started, you see the candle started changing, it's a sign. The market will always give you a sign. So at this point, if you've been in this market from here, it is time the party is over. It is time to get out. Now, what you saw here as this bullish candle here is a stop hunt. It's a deceptive candle, exactly like what we have at the B here. All right. So when you see this candle here, and this is what completes it. When you see this bullish candle, which makes you think that the market is going back up, this is when most people buy. That, oh, it's going back up, it's continuing. And all of a sudden, you now see a bearish candle which closes below this trend line here, below this the EMA here. Once the market closes bearish, and especially when you see this, because you might not get it clearly when this finish, but when you see this candle here, that shows you that a bearish trend is coming. So you simply get out, because it's going to drop, because this is going to represent point B and point C is going to happen. This is what happens all the time in the market, no matter how many years you go back. The same thing happens over and over again in different ways. Okay, so that is Elliot wave application. So always look at this application when you're trading. Ask yourself, what wave are we in? When someone tells you, oh, this coin is pumping, you ask yourself, what wave? Are we in wave 1? Are we in wave 2? Are we in wave 3? Are we in wave 4 or wave 5? So if you are in wave 5, you have to trade cautiously, because there's always going to be a retracement. All right. So that sums it for Elliot wave. So the next thing we're going to be looking at, for the person who asked if I can just show them how to do spot trading. Like I said, spot trading is just instant trading. Let's take, for instance, you want to trade, let's say you have BTC, for instance, okay, and let's assume you have USDT, for instance, and maybe you buy into Bitcoin because you now realize, maybe you think that Bitcoin is going to start going up now after the drop, right? So you simply, any market, this is applicable to every market. You can do this on Binance, you can do this on Sex.io, you can do it on various other exchange platforms. Okay, and for some of us who are new, the reason why there is exchange platforms is to enable you to be able to exchange one token or one coin to another coin. All right, when the crypto space started, in 2009, 2010, there was nothing like exchange platforms, all right? Because Bitcoin was the only guy in the space. So there was no need to exchange Bitcoin to any other token until Ethereum came, Ripple came, and other, crypto projects began to spring up. So there was a need to have an exchange platform where you can exchange Bitcoin to Ethereum or Ethereum to Bitcoin. So that's what brought about exchange. And that's what we call, that's more like buying and selling. All right. That's what brought about spot trading on the exchange. Okay. That is for the newbies, for those who don't know why we have exchange platforms. So spot trading, like I said, is one of the fastest trading system in the exchange. Okay. If you're not doing leverage trading, let's use, for instance, or let me say, I have ETH. Let me just explain that with ETH, for instance. Let's see, ETH. Let's say BTC ETH. So now I have some Ethereum and I want to just buy Bitcoin with it because I think, the price of Bitcoin is going to, continue going up. So I want to spot trade. So I simply change it. I simply exchange my Ethereum to Bitcoin. How do I do that? Very simple. You see, we have the spot. Okay. You have the spot trading here. So all you do is you have the limit. The limit simply helps you, for instance, if you are in this market, all right, and with the way you're seeing the market, you think that by the time this market gets to this level, let me remove this just a minute. Maybe in your own personal analysis, you've agreed with yourself that by the time the market gets to this price at 51,562, the market is going to drop back down, and you want to get out. Okay, so you already have Bitcoin already, but you want to get out at this point. That is when you use the limit. The limit simply says set the price at which you want to buy or at which you want to sell. So if I already have some Bitcoin here and I want to sell at a specific, for example, Ethereum, for instance, let's go to the Ethereum market. Here is ETH. Okay. BTC ETH. Just a minute. So here is BTC ETH. Okay. Now let's assume that based on my analysis, I've concluded within me that maybe by the time the price hits this ceiling here, there's a very big ceiling. There's a ceiling here. There's a resistance level here. Okay. If this guy does not break this ceiling, there's no way it's gonna get to this price, right? So maybe I've concluded that by the time the price gets to 0.032, which is where this red line is, the market might go back down. So I just want to stay out, or I want to switch my Ethereum to Bitcoin. Okay. So what do I do? That's when I use the limit. I simply say, I'll simply come to the limit and go to my sell because I already bought Ethereum here, for instance. All right. And I'll just set that price, the price at which I want to exit, maybe at 0.032298. I just come here and type 0.032. Just a minute again. Okay. 0.032314. Let me use that. 0.032314. As soon as I do that, I'm simply saying that at this particular price, I want to switch my Ethereum to Bitcoin because I believe that the market might drop at that price. So all I just need to do is just determine how many percentage of my Ethereum I want to switch. If it's all of them, that's 100%. So you just move your cursor and determine how much you want to switch. And then you sell it. So when you sell it, for instance, if you sell it, what happens is that the market will be open here. It's going to wait until the price gets to this particular price, 0.032314. Once that happens, whether you're in the market or not, it doesn't matter where you are, the order is going to close and your Ethereum will be back to your Bitcoin straight away. So that's how you use limits. But for spot, it's instant buy and sell. Okay, let me cancel this. For spot trading, we use the market. All right. For the market, what I'm saying is that I want to immediately sell. I want to immediately sell my Ethereum at this price. So if I want to immediately sell my Ethereum to Bitcoin at this price, all I need to do is just choose the percentage of my Ethereum. You can see there's about 3.4 Ethereum here on this exchange. All right. So I can just choose how much of it I want to sell and I sell it. Once I do that, for instance, let me just take a percentage. And once I sell it, instantly the value of Ethereum I'm going to sell is going to change into BTC. So I've sold it. So that is how we do spot trading. Okay, it's just that easy because it's an instant buy and sell. But what we're trying to teach in this session is how to do it the right time. Because now that Ethereum is going up, It doesn't make sense for me to sell my Ethereum. It doesn't make sense. I'm going to miss out of the bullish trend because everything about this market shows me that the Ethereum is going back up. If it breaks this resistance, I'm finding my Ethereum here. So why should I sell it now? It doesn't make sense. So I have to wait until, all right, I begin to see some form of what? Resistance, okay, at this level. If there's strong resistance at this level, then it means the market is going to drop because it's just like a ceiling. When the market hits a ceiling and when you hit your head on a ceiling and you can't break for that ceiling, you have no option. After constantly hitting that ceiling, you're going to come down, right? The force of gravity is actually going to bring you down. It doesn't matter the pressure that it doesn't matter how you know, how you, the force that you're using when you're jumping. If you cannot break over the roof, it's going to go down, okay? So I would have sold some of this Ethereum to BTC, but I wouldn't do that now because Ethereum is still going up and I'm still benefiting from the bullish trend. Okay, I hope that answers your question. I don't know who asked that question. That should be Elizabeth. I hope you now understand how you do spot trading. I think it's clear. I hope it's clear to you. Okay.
I have a question.
Yeah, you can just type your question in the chat box so I can be able to attend. Okay, good. So that's how you do spot trading. We'll be taking questions in a brief, but let's just round up on some of the points we want to make. Let's go to the next thing. We've talked about the application of the dot theory. You see, if you can learn how to apply all this in spot trading, you're going to be a good spot trader. You feel so comfortable. Like what happened yesterday, for instance, I showed you what happened yesterday. What happened yesterday, for instance, looking at for those who understood how this market worked, you see, they are not in any kind of tension right now because they already knew when the 1 day candle started forming. So every good trader does not go to sleep. Oh my God, I don't want to say this, but excuse me. Every good trader in the crypto space does not go to sleep until you confirm the direction of the 1 day candle. It's funny, but it's true. Every good trader stays awake. You monitor your market until the 1 day candle begins to form. If you cannot decode the direction of the 1 day candle and you go to sleep, what you're just saying is that no matter what direction it goes to, I don't care. Because like I said, the 1 day candle determines what happens virtually in every market in a particular day. Okay, so every good trader waits until the formation of the except if there is a general bullish trend. If there is a general bullish trend, like for instance what I'm seeing here, okay, by the time the next 1 day candle forms, it's going to test some lower point and continue the uptrend. All I can see here is a continuation of an uptrend after a little retracement on the downside. So based on experience, I already know that the next 1 day candle is going to be bullish based on my experience. All right. But I will still wait until that candle forms. Okay. And it's going to form, 12 a.m. my time. It forms 12 a.m. every day. Okay. So you have to wait to see how that candle is going. For instance, if you waited to see how this 1 day candle was going to form and it started, you'll see it to start falling, showing this red. It tells you that that day is going to be bloody. You just close except for some tokens or some coins that you're holding for a long term. There's some coins that you're holding that you've told yourself, I'm not going to sell this coin until 2022 or 2023. Then don't bother yourself. Just relax. But if you're a spot trader, if you have some capital, all right, maybe you have some $5,000 or $10,000 you're using for spot trading, which you just want to use that to take advantage of the ups and down moves and kind of get more coins and get more dollars for yourself. When you see this happening, it tells you one thing, that the day is going to be bloody. What do? You just hedge and stay out and go to sleep. Okay. So if you did that yesterday, you wouldn't be part of all this downtrend. Now you should be part of those who buy at the lowest price. Okay. Because that is how the market behaves all the time. So you don't go to sleep until you see until you confirm the direction of the 1-day candle. Then you can sleep well. Okay, that's a high level trick there. Okay, there's still a whole lot of them, but we actually expose more in our training session. I think someone typed something on the chat box. Someone said, "Oh, really?" Someone said we lost you there. I don't understand. Oh, Lisa, how you had a
No, it's
network
okay. We
issue?
got it. Yeah. It just dropped
Okay.
off for a second.
Oh, good. So that is part of the trick. All right. So let's look at the next point. I believe everyone here should be able to just read more about Doe theory, just understand the fact that, let me quickly say something before I round up on Doe theory. The image you saw here, what it simply means is that you see in every market is controlled by buyers and sellers. All right. A market starts up at this point zero. For example, sometimes you see news of hype. All right, someone tells you, man, Doge is going to do 50% before the end of the day. Maybe this news has gone around. Like the day Elon Musk, I think a few weeks ago, Elon Musk bought over 1.2, I think 1.2 billion worth of Bitcoin or thereabout. That was a hype, right? So many people, when they heard this news, boom, they were in for Bitcoin, right? I think it happened in Doge as well. So when that happens, that first drive, people buy. So it creates that first wave, which shows people that this coin is pumping or is going up. That's wave one. Now, those who bought at this level, when it gets to a particular point, based on emotions and personal level of understanding of the market, to some people, 10 to 20% profit since they entered at this level is enough for them. So they just simply get out. So as people begin to leave the market, okay, there's always going to be a lower low. This is what we call the higher highs and the higher low. Okay, between here and here is the higher highs, and between here and here is the higher low. So when people begin to take profit, when the first buyers begin to take profit, what happens is that the bears take the market. There's going to be a partial retracement. This happens in every market. So this partial retracement creates the second wave. Now, when it retraces, there's a trick for you to understand when the market is about to take off. Okay, but we'll discuss that in depth in the training. Okay, so when you see when that happens and there's a retracement, before you know it, some people who already took profit here, they start buying again. So when they start buying and the candles start changing direction, that is why candlestick is very important. When it starts changing direction, you'll see more people will plug into the market, and the candles will move. And when it moves at this point, there are still some people who are very patient, who they actually bought at wave one or at this level, but they understand the market. So they were not in a hurry to cash out. Some of them are going to start living at wave three. All right. And sometimes because of the zigzag manner of the market, some people might not be able to clearly see what wave the market is in. Sometimes wave three looks like wave five. Sometimes. So if you cannot count properly, you might mistake wave three for wave five. So that happens all the time because of the inconsistent manner in the way the market moves. So most people from here are going to try to. Some people from here, they've made enough profit. They're going to try to cash out here. Some people who bought here as well are going to cash out. There's some people who also bought at the middle here who will also cash out. So there's going to be a second retracement to give us wave four. And when that happens, that is when the main run will begin. When that happens, this retracement sometimes it can take 2, 3, 4, 5 hours before you begin to see the change in direction. And that is why when we're trading, we don't joke with U-turns, because you see this market, the market always shows you everything. Just that most times we don't pay attention to the market. The market shows you everything. And let me show you why. If you look at this market, every time the market is going to change direction, it will show you. But most people don't take it seriously. All right. Now, there's always a sign. If you go back here, for instance, you see the market drop down here, there's always a sign. You always see a sign. That is why using the candlestick is very, very important, because the candlestick will show you, like what we have here, for instance. The market is telling us that, the bearish trend is almost over. the bullish trend is beginning to take place, and you will always see the U sign. You will always see it. So this tells you that there was a bearish trend here, but now the market is changing direction. But it's not going to change that direction all at the same time. It's going to take some time, but the market direction is changing. So if you understand the market, you'll be able to follow the market based on its what? On its direction. Right? So that is what Elliott wave is. So at level 5, which is the final wave, almost everybody wants to get out of the market. And that is when you have the A. When that A happens, some people will buy, but not everybody. Some people will buy. And that is the most temptious part of the market. It becomes so tempting. Whenever you see a trend that has gone up, okay, and all of a sudden, you can see it here, playing out here. Can you see this here? Look at it here. You see, whenever you see a market that has gone up and retraced, and it started behaving as if it's still buying, be very, very careful. Especially if after 1, 2, 3 hours, the market is still not buying. Just know that the long red candle is on its way. It's going to come. It always comes. Okay, for instance, here, what happened here? All right, after the correction and the bullish candle, you see, this is very you see, this point is very tempting. There's always that thought that will tell you we're going up, and this candle also started as if we're going up, and it ended up closing bearish. Once you see this guy, it tells you that something is coming. It's no longer going up, and that is where you see the correction to complete what Elliot told us here. That is C. So B is a very tempting part. Okay. So we're moving straight into the next thing. Spot trading. Someone is asking if you have to pay fees when spot trading. Definitely, the exchanges make money through your fees. So if there is no fee, I don't think any exchange will be functioning, because that's how they make their money. Binance make billions and billions of millions of dollars daily through fees. Okay, so as you're changing from Ethereum to Bitcoin, from Bitcoin to Ripple, whatever you're changing from, once you close that order, you're paying some amount of fees. So, but what happens is that this fees varies depending on exchanges. Some exchanges you pay so much. Okay, so you have to check the fee and see if it's convenient for you before you do what? Before you trade on a particular exchange. All right, I think that answers that question. Now let's move to the next thing, please. The next thing, we've talked about Doe theory. You can do more research about that. I've talked about Elliott wave as well. Moving average, yes, moving average. Some of us know about moving averages, but it's very important for you to understand what particular EMA that you're going to use, because the moving average becomes very functional depending on the values that you're using. Okay, like everything I'm explaining here on this market, you can see it very clearly. These lines that you see are the moving averages. These are the exponential moving averages. It tells me clearly what the market is doing. For instance, at this particular level, at this level, let me not go too far. At this level, I already see the resistance here. This moving average line is already telling me that there is a resistance here. All right, just like what happened here. This is a resistance line. So the market gets to this level and it could not break this red line. By virtue of the red line pulling down, when you see this and the market is not getting to this red line, even if you don't believe, by the time you see this red candle down, especially broken through this other EMA, it tells you that the market is going to drop. You just get out of the market. That is the essence of the EMAs. They show you, they show you the levels of the market. Okay. When you use the correct EMA values, you see the proper support and resistance levels looking at you in the face. You just need to trade alongside with them. So if anybody tells you that EMAs don't work in the market, it's a lie. They are actually using the wrong ones. Okay. For instance, what we have right now, my EMA is already showing me a form of resistance here. So if this market struggles its way to this place and begins to play funny, even though I expect you to break it off and get to the next ceiling, if it struggles to break this ceiling for several hours, I'm going to jet out of the market, because I know the long red candle, just like this guy, is still going to come again. But if it breaks through this red guy, then I'm sure it will get here. So these things help you as the market progresses. You'll be able to understand how far the market is going to get to before there will be a retracement. Okay, this is actually not question time, but I'm getting a lot of questions. Okay, this from Mr. Rick said, okay, usually around 0.2% for trading fee of the amount you traded. Most exchanges will charge lower. Yeah, that's true. That's true. That's true. Like I said, different exchanges with different rates. Okay. Someone is asking if there will be a correction for BTC coming soon. We're going to do that as the last part. In our last session, we're going to analyze the Ethereum market and the Bitcoin market and see, where the market is actually going. Okay. Someone is saying, okay, which is better, the BTC USD pair? Okay, better in the rising market. Good. I'm going to talk about that. Okay, I'm going to answer those three questions briefly, but let me answer the first one. Now, when you're doing spot trading, the best currencies to trade are the ones that move the market. Everyone here will believe me that Bitcoin and Ethereum, okay, Bitcoin number one, when you go to CoinMarketCap, Bitcoin dominance in CoinMarketCap is about 62.6%. That tells you the power Bitcoin has on the crypto space, which means if Bitcoin is going up, every other coin follows it. If it's plunging, every other coin follows it. Okay. So when you're doing spot trading, you don't go start trading repo. Well, you can do that if, you can take advantage of such moves. It's actually profitable if you can do it properly. But remember that when you're trading other altcoins that are not as strong, that doesn't, when you're trading altcoins that doesn't have much market capitalization like you have it in Bitcoin and Ethereum, the volatility becomes too much. Okay. But when you're trading, the majors like the Bitcoin and Ethereum market on spot trading, all right, the volatility is there, but the difference in what you're going to be, the difference in what you're going to lose or what you're going to make, it's actually quite favorable for you to trade all these coins. Because, for example, if I'm trading Ethereum USDT, for instance, I know very well that, as Bitcoin is moving, Ethereum follows it up. All right. So if you have like 10 or maybe 5 or 10 Ethereums, now Ethereum is moving, maybe currently we have it at 1,543. Okay. And let's say within the next few hours, maybe the next 3 hours or thereabout, we are at 1,662. So if you have 5 Ethereum, how much have you made? You just do the difference. 543 minus 1,662. I think you've made more than $100, right? So you times it by 5. That's $500. You're good for the day. Even if the market gets here, even if the price of Ethereum gets here and starts struggling with this guy, once it starts struggling with this line, it is time to get out. If not, you're going to lose the 500 you've made. So that is spot trading. Okay. So it's good to stick to the majors. Okay. You can stick to the majors. USD, USDT, BTC, USDT, ETH. Perfect. All right. Always try to stick to the majors. But when you take advantage of the alt in spot trading is when for example, when the trend becomes very clear. All right. When the trend becomes very clear that Bitcoin for the whole of the day, for instance, if a bullish candle begins to form here tomorrow, if the next candle that's going to come by 12 a.m. becomes bullish, you know how a bullish candle forms. This guy will try going down a little and then take off. Once you see it taking off, that tells you that this candle is going to end bullish. So what do? You can take advantage of the altcoins, because now that the price of Bitcoin has dipped, most of them are down, right? What do? You buy some of them and hold it as the market, as the bullish candle of Bitcoin, as the bullish candle here on Ethereum or Bitcoin continues to go up on the one day, those other altcoins also follows through. So you're going to rake a lot of profits on those alts, but make sure you get out. Make sure you get out before the retracement begin, because if you don't get out, you're going to lose even more. Okay, so that is how to trade it. So, but the best is stick with the majors. All right, Lisa, I hope that answers that question. Let me look at the next question. The next question says, Lisa, is that clear or you need more clarification?
The reason why I asked this was because there are some traders I know, for example, instead of Ethereum USDT, they trade with Ethereum Bitcoin. So, you know, I my philosophy is Bitcoin is still a store of value, so I'm very uncomfortable with selling my Bitcoin. So I just want to keep it, and then I kind of keep a pool of USDT to trade with the altcoins. The thing is, there are some traders who, buy just a bunch of Bitcoin and use that Bitcoin to trade. So I was wondering which strategy is better. Should I use USDT to trade or Bitcoin to
Okay.
form their currency pair?
The reason why I prefer USDT, okay, or USDC or Binance dollars is because you can easily hedge. You understand? When you see, a market correction coming, okay, you can easily switch to dollars, right? Except you're holding for long term, like you said, okay. And for the alt, you can actually spot trade the alt, but make sure the analysis that you're doing, you are doing it with the majors. For instance, I'm doing analysis with Bitcoin USD, all right? And I already know that for a period of time, the Bitcoin price is going to be up, and I'm trading an altcoin. So what I do is that I buy the lows of the alt, and because I know very well that because Bitcoin dominance is almost 65%, when Bitcoin is going up, those alts are going to go up. So what some traders do is that they do their market analysis using the Bitcoin dollar market, okay? But they trade the alts because they want to make more profits, because they know that once Bitcoin moves, those alts also move in that direction. But like I said, if you're doing that, it's okay, but make sure you get out before there's a correction, because if you're trading cheap alts, okay, if there's a correction, you're going to lose even more. You're trading alts, especially the cheap altcoins. Okay, so is that clear? So you use the
Yeah.
Bitcoin dollar to do your analysis because the Bitcoin controls the entire crypto space, right? And you enter properly with your alt. So if you think that for this day, for instance, Bitcoin price is going up, by the time you conclude on that analysis and you determine how long it's going to go, maybe for the whole of the day, maybe the 1 day candle is actually bullish and strong. All right. So you buy the alts. But when you see the next day candle becoming bearish, it is time to close on the alts, because if it becomes bearish and start dropping, those alts are going to what? Also drop. And your profit that you've made, you're going to lose it. You get it? Okay, so you can do your analysis with the majors and trade the alt. Okay, I think that is clear. Someone said, which time frame do you recommend us looking to determine when to buy or sell? 1 hour time frame, and I'm going to talk about that briefly. Okay, it's 1 hour time frame. So let's look at this. Yes, funny enough, that's a topic. That's the next topic. That's point 7. The time frame application. Okay, before now, I've talked about the essence of the 1 day time frame, that you don't go to sleep until you see what kind of candle is forming, because we have these time frames all the way from 1 minute. Here we have it up to 1 month. Some charts you have it up to 1 year, 2 year. What it simply means is, the time frame simply shows you how long it will take for a particular market cycle. Okay, so now that we're using candlestick to analyze the market price and the market direction, when you're trading, the first time frame, if you're a daily trader, some people trade weekly. Some people, they buy a coin on Monday, they want to close it on Sunday. So those are weekly traders. So those kind of people, they pay attention to the 1 week time frame, right? The such kind of people, for such kind of people, beginning from the first week, when this candle started forming, they would have known that this entire week, all right, is bearish. So they should have left the market here. All right. And for those, but the best way to operate is the 1 day. Okay. But some people are monthly traders, some are weekly traders, whichever one you are. just take advantage of the trend that attains to where you are. So let's use the 1 day, for instance. Now, today, for instance, this is where we are. Yesterday, we had a bearish candle on the 1 day. Ethereum dropped all the way. And yes, 2 days ago. Yes, yesterday. And this morning, 12 a.m. too, we started another bearish trend. So there is a bearish trend. So now what it means is that from the 1 day time frame down to the 1 minute time frame, they will all move in the direction of the 1 day. If 1 day is selling, they're all going to be selling. But there's always going to be, market movements, up and down movement in the lower time frames. So when you want to enter the market, you pay more attention to the 1 hour time frame. The 1 hour time frame is a perfect time frame to go into the market. The 1 hour time frame is a time frame that tells you it is time to buy, right? Because within an hour, within a completion of a full 1 hour candle, you can tell where a market is going. 1 hour is enough time, even though sometimes we use 30 minutes for more quick entry. But when you're using 30 minutes for your entry, you must be very careful that you're not entering too early, because sometimes 30 minutes might give you a buy sign that it's time to go in, and the 1 hour is not ready. And before the 1 hour is ready, you discover that that was just a temporary what? A temporary signal. But when it comes to perfect signal, when 1 hour tells you, when the 1 hour time frame tells you it's time, okay, just know that it's time to buy, because the 1 hour time frame is a strong time frame. So from the 1 hour time frame, we look at the 4 hours. If the 4 hour time frame is not ready, it's not showing any sign of changing direction, you don't go buying on the 1 hour time frame. Because when you go buying, what you're saying is that you're trying to use one cement to lift four other cement. Now I'm using cement as a, I can use weight. All right, let's use a 1 kg weight to 1 kg to 4 kg. So you have 4 kg falling, and you now use 1 kg to try to lift 4 kg. I'm sure you're going to have it hard. You're going to have it hard. And if your power is not, if you're not strong enough, it's going to push you down again and continue down, because the weight of the 4 hour is higher than the weight of the 1 hour. So when you're entering the 1 hour, you must have confirmed from the 4 hour that there is a market changing direction. For instance, what happened here, you saw the 3 red candles falling. Like when these candles were falling, this is not time to go buying on the 1 hour. You wait until you start seeing a bullish candle forming. That tells you the market is changing direction. So that is the best time you will see that sign on the 1 hour time frame, and then you buy in. So when you buy in, as the 4 hour moves up, the 1 hour follows. Okay. So, but you don't wait until the 4 hour gives you the entry time, because 4 hours is a long time. You would have missed a lot. But 1 hour will always give you that good sign for early entry. So when it comes to entry, 1 hour is a standard. When it comes to, detecting the direction of the market, never joke with 4 hours, 6 hours, and 8 hours. If you don't have 6 hours and 8 hours, the standard 1 hour, 4 hour, and 1 day, because different charts with different time frames. Okay. So the time frame is actually a topic of its own. There are some other tricks you need to learn about the time frame, but we may not be able to finish everything here today. Okay, but one thing you must understand is that the higher time frames control the lower time frames. Never buy against the higher time frames, no matter how juicy, the signal appears to be. All right, always look at the higher time frames. For instance, if every time frame from 1 day, 8 hours, 4 hours, and 6 hours is bearish, you don't go buying on the 1 hour time frame. It's a temporary buy. It will pretend as if it's buying, and before you know it, the red candle will knock you down. Okay, because the higher time frames are not ready. So pay attention to the higher time frames and make your entry, your early entry, with the 1 hour time frame. Mr. Rick, I hope that answers that. So those are time frames, different time frames. Each time frame, like I said, indicates how long it takes for a particular candle to form. For those of us that are new to time frames, okay, different time frame. Now we have 4 hour time frame. It means every candle here takes 4 hours to form. And we just use the 4 hour time frame to actually detect the direction of the market. Okay. Now, so that is time frame. There are other things about time frame, but we might not be able to exhaust all of them here today. Okay, let's go to the next thing, which is support and resistance application. Very key. These are very important things when it comes to everything that you're seeing here. For instance, I talked about the best way to get good support and resistance is proper EMA values. When you set the proper values, you will see it yourself. So when we talk about support and resistance, we're talking about, let me use a very simple language like a bridge, okay, and a roof. All right, a bridge is more like a bridge is more like a support. For example, can you see this the green line, the long green line? This is the support. This is a bridge. It looks more like London Bridge. Yeah, you can see the market bounced on the bridge. It couldn't break it. Went up again and bounced on it again. It couldn't break it. Okay, but let's see what happened when the bridge was broken. Here we go. As soon as the bridge was broken, the market fell inside the water. So this is the market. As soon as this happens, so if you have the right bridge and the bridge has been broken, the bridge that could not be broken all through this place, and now you find out that a particular candle have actually broken the bridge. What the hell are you still doing in the market? The bridge is broken, which means the market is what? Is going to go deep inside the water. So you, as a good trader, once you see that the bridge is broken, you're already out. Okay. Now we have different kind of bridges. Okay. We have the inner bridge, the outer bridge, the secondary bridge, and the future bridge. Okay. You can see here, let me just enlarge this a little. Okay. Okay. All right. So you can see we have three lines here. The first line indicates the inner trend line. This second indicates the outer trend line. This indicates what? The secondary trend line. All right. We still have the future trend line, which tells us the last level of support. So support is more like a bridge. So when this first support was broken, this first line was broken, it's a very good sign that market is about to change what direction, because all through this place, the market kept on, walking on the bridge. All right. Then here it broke the bridge and consolidated again and broke the two bridge at the same time. And now, even if you don't believe the trend is going down, it still came down and broke the final stronghold of the market. And that is why you see the market down the water. Now the market is in the water trying to what? To sail afloat. The market is trying to come up again. So when can we agree that the market is back? Excuse me. Now, the market is already in the water because the bridge, which is the support line, has been broken. So the only time we can agree that the market is back out of the water is when it comes above this bridge. All right. So if the market refuses to break this bridge, if it refuses to actually come on top of this bridge, that means the market is still going to fall back into the water. So you want to stay away as much as possible and take advantage. For example, if the market gets to this resistance and it doesn't break it, if it breaks it even with a little inch, that means it's still going to test this bridge. When it tests this bridge, if it breaks this bridge, wow, then we are up to a new trend. Who knows? We might see 2,100 in a few days if this bridge is broken before the end of the day. But if this bridge is not broken, the market is going to test the bridge. If it tests it and it can't break it, it will go back down again. So that is how it works. That's support for you. Okay, resistance talks about the uptrend. This is a form of resistance. Let me get my tools and get my trend line. Okay, I already have one here. Oh. So this is a good example of a trend line. Let me just, a trend line represents a ceiling, a ceiling or a resistance line. A resistance line, sorry, not trend line. A resistance line represents a ceiling. When you shoot a projectile from a particular point, or now that projectile gets to a point and it can no longer go up. So that point where the market begins to struggle is a resistance point. So there is a roof, there is a ceiling preventing the market from continuing the uptrend. So that ceiling is all called the resistance line. So when you draw the ceiling correctly, you can tell how far the market is going to go. Trying to make this as simple as possible. Okay. So here is a good example of a resistance line. You can see at each of these points where I drew this line, you see the market actually tested it. It's like a roof. Okay. The market starts from here. You see, it tested this roof at this level. It couldn't break it. Then there was a retracement. It came back, tested it again. It couldn't break it. It's just like jumping up from the floor and trying to break over your ceiling, and the ceiling becomes too strong for you to break. What happens? You start feeling pain in your head, and then you jump down. Okay. Now, after some time, you take some relief, gather some strength, gather some momentum, and then you push yourself again and see if you can break the ceiling. And you cannot break it. You hit your head on the ceiling. After continuous hitting, you discover you're already weak. Then you fall down again. That's a good example of what? Resistance. So if you can draw your resistance lines correctly, for instance, these ones that we've drawn now, this resistance that we've drawn, this is automatically showing us the future market trend of this particular token. Now, if Ethereum moves up now, breaks all this bridge, okay, and start the uptrend. So how are we going to know how far it's going to go before another retracement? Just like what happened here. What happened here yesterday is going to happen again and again and again as far as the market exists. So the resistance line is going to show us the next one, okay, when the next one is coming. And that is why you see this straight line. You can just keep drawing this straight line. As the market progresses, you draw it, because by the time this market returns back on the surface by breaking this, by climbing this bridge, which was broken here before the market fell into the water, by the time this bridge, the market comes back on top of the bridge and it starts going up, this resistance is going to tell you how far the market will go. Now, by the time the market gets here, maybe in a couple of days from now, or maybe maybe in a couple of days, the market gets to this point and starts hitting this line. Then all you need to do is to pay attention and see how it's hitting it. If it hits it and breaks it once, man, we might see $3,000 Ethereum. But if it hits it and start playing around it, testing it and testing it and testing it, there's a sign, there's a possibility that after some testing, it's going to drop back down. Okay, so resistance helps us to determine the future uptrends, or the future up levels, or the future high price of the market. Okay, and why the support helps us to determine how far the market is going to go when it's plunging on the downside. Okay, so that is support and resistance. In some, I think there's some charts. Okay. That's true. Yeah, it's funny, but that's it. You see, when you look at the market, just put the idea of the ceiling and the bridge in your head, because the market does this. The market does the same thing over and over again. Every market actually does this. Okay, every market does this. Even stocks, any kind of digital asset does this in different ways. They do the same thing. So support and resistance is very, very important. So now that we've drawn our resistance, now we are waiting to see what the market does with this bridge. If it breaks this bridge, that's the beginning of another bull trend. So as the bull trend begins, how far is it going to go? This line that we've drawn from here, remember, to draw a perfect resistance, you must pick the levels where the markets have touched previously, because technical analysis is all about using past occurrences to predict the market future. All right. So when you're drawing your line, you must make sure you can see the market tested this point sometime in when was this? Let's look at this. I think this was sometime around what date was this? Yes, sometime around 1st of January 2021, the market tested this level. And now it has tested the same level as well at this point. So the next time this market breaks above the bridge, which is this bridge, and it starts pushing up, this resistance line is going to tell me, the next point of call, how far it's going to go. So if the next one comes in and start bouncing on this line, I'm just going to watch. When I begin to see a U-turn of a retracement, I'm out of the market because it's going to drop. So that is how it works. I believe that is clear. So on support and resistance, you can read more about support and resistance. That's how it works in every market. That's how it works. So the next thing is bullish and bearish trend. Okay, I think I've talked about this, but there is still some other trick on this. But actually, we go more in depth in our training, like I said, like the candles that I showed you, each of these candles, there are some tricks, because understanding how this candle moves, it depends on how you see the candle. For instance, I can tell you based on experience that the next 4 hour candle is going to be bullish. It's going to be green, just like this. Based on experience, I can say that. All right. So, and whenever you're monitoring a candle, okay, whenever you're monitoring a candle, there are some within, for example, on the 1 hour time frame, for instance. Now, there is a way a candle moves. At some point, if you just try observe this, a 1 hour candle, for instance, at the between the 40th and the 45th minute, all right, between the 40th and the 45th minute, there's always a pullback. There's always this sign that tends to show you that if it's a bullish candle, you would always see this sign that makes it look like, no, the market is coming down, it's dropping. But always wait to the end of the candle. Very important. Let me say this now. Let me give you one trick in bullish and bearish candle. No matter how you see the market, okay, before you make any trading decision on the 1 hour time frame, always wait for the completion of the 1 hour candle. For instance, in this, if I'm just meeting this market and I can see that the market is changing direction, this is the bullish candle, and this is the third bullish candle. You see, I won't just jump into this market, though I know this candle is going to end up being bullish, but professionally, you are supposed to wait the end of this candle. Now, if you develop the habit of waiting to the completion of the 1 hour candle, if your entry point is 1 hour, or whatever entry point that you're using, the standard to me, based on experience, is 1 hour. But if your entry time frame is 30 minutes, always wait for the end of the 30 minutes candle before you make your entry. One thing to save you is this: some candle begins so bullish, all right? And if you are the type that you just want to jump in, you're going to jump in, but before the end of that candle, the price might push down. It doesn't mean that the market is not going up, but you would have entered more early if you had waited for the candle to complete. All right. So, and also, if you wait for some candle to complete, you're going to save yourself some market retracement, because sometimes some candles start bullish, and before the end of that candle, it turns bearish downwards. So if you're the type that waits for a particular candle to complete before you make your decision, you will see that you will spare yourself of so many loss when you're spot trading. Okay, I'm going to give that one trick. The rest, we do that in the training. Okay, so that is on. I've already talked about bullish and bearish candle. We already know what it look like, you know. So that's a trick which I just gave. And the next thing, financial management, very key. Okay. Um, Sorry. Okay, I got muted. Okay. Financial management, very, very important in spot trading. I hope everyone understood the 9 points, because we are point 10 right now. I hope the 9 points are very clear. We're rounding up actually. Okay. Does everyone understand this 9 points? I know some of us are new to trading. Some things might look strange, but to some people who have already been trading, this is one, it's just an addition. All right. Okay. So financial management is very key. When you're trading, you don't just it's always wrong to put in all your trading income in one move. Okay. For instance, if you're spot trading, I just use an example. If you're just making this market and you want to buy from Ethereum, maybe you already have this knowledge and you know that the market is still going to push up at least up to this level. If it breaks it, then it's going back, it's going up to this level. All right. Now you know the market is going to go up a little and you want to go in. So what do you do? Do you just put 100% of your investment fund straight up to buy Ethereum at this point? No. What you do is you put in 50% and wait for the next two candles and see what it's going to do. If it's really going up, or you can even put 50% and wait to see what happens when it hits this resistance line. If it hits this resistance line and breaks it, then you put in the next 50% because because this is broken, definitely it's going to hit this guy before there will be any form of retracement on the downside. So if you are the type that trade that way, what will happen is that sometimes, even if you enter a trade and it goes back down on you, you still have some backup funds to kind of buy low. All right. One, you already know the direction of the market, but you see, even though you know the direction of the market, you cannot 100% state, the temporary market direction. Market can go zigzag, even though it is on the right trend. Market can misbehave. It happens. Like for instance, this particular candle, for instance, you can see there's a lot of downward pressure on this candle because the market is still bearish. Okay, even though we are seeing this atom of bullish trend, this candle you see before the end of this 1 hour, it can change to a bearish candle and close on this line. So if you're the type that's putting all 100% of your funds at this point, what happens is that when it comes down here, you're going to be at you're going to be at a loss in a way, like the value of your token would have dropped in a way. But if you're the type that use 50% up here and it comes down to this level and then begins another bullish candle in the next hour and you buy with the remaining 50 candle, what happens is that between here and here, you're going to make back what you lost here, all right? And then come back to your main capital and continue the trend on the upside if your prediction is right, if your analysis is right. Okay, so that is what fund management is. Always make sure you manage your funds. You put in a little. Some people do as much as you put in. Sometimes, if you look at the charts and you're not too sure, all right, when you look at the charts and you're not too sure, you just put in 25% or 30% for the next 1 hour. You watch and see, because sometimes you might need to wait 1 or 2 hours to confirm the actual direction of the market. Sometimes it may not be clear. So if you are in that position and you just want to be in the market to confirm what you're seeing, what you need to do is you put in 30% and you wait. If after that 1 hour, it becomes very clear that this market is bullish, then you put in 50%. That's how you trade your path, to the top. Okay. So I think there's a whole lot of another thing about financial management is I want to talk about emotion. Emotion is also part of this topic. I'll actually add emotion to it. In the crypto space, whatever goes up will always come down, and whatever goes down will always come up. If you happen to mistakenly you buy at the top, okay, of the majors, I'm not talking about some shit coins that their projects are not so clear or certain. I'm talking about the majors, maybe like the major coins that that are actually making waves in the crypto space. When you buy them, even if it drops on you, just relax. Okay, it's gonna go back up. That is how it works in the crypto space. Okay, so emotions, when you're trading crypto, you put emotions aside. That is why some financial advisors always tell you always trade with what. When they say always trade with what you can afford to lose, well, they're making a point, but I would say always trade with what you're comfortable with. Okay, so be trade with what you okay. If $2,000 is what you're comfortable with trading with spot trading with, use it and trade with it. Okay, if $5,000 is what you're comfortable with, use it. Just be at your pace. And if you happen to enter the market maybe wrongly, or you didn't follow the trading rules and you entered wrongly, No problem, just wait. It's still going to go back up. It's just a matter of time. So those who lose in the crypto space are those who bring in emotions. They quickly sell when the market is dropping, and that's when people start buying. Before you know it, it goes back up. They buy, they buy again at the top, it goes down, they sell again. So you don't want to be in that position. Okay. So take emotions out. The entire crypto trend is bullish. Everything we're seeing here, Ethereum here is still around 1,558. Very good time to buy in. Who knows? By this time next year, one Ethereum might be playing around $10,000. Okay, because of the what? The demand. Even though we have Ethereum 2.0 coming in, I think a whole lot is going to be happening in Ethereum within the next 1 to 2 years from now as the 2.0 network stabilizes. So the general trend is bullish. So in the crypto space, we don't trade the crypto space with emotion. Okay. So I think that's one of the final points we'll be talking about here. Don't forget, we have our main trading sessions where we we go in depth in some other topics. This is actually supposed to be question time, but I think most people have been asking questions, and I think it's been interesting, using those questions to explain some of the things we're doing as so this is question time. You can ask questions. Another thing is how you can join Jack's Crypto Training Institute. Let me just round up with that. You can drop your questions on the chat box if there's still questions so that we can take them. But while you're doing that, if you want to actually enroll in a crypto training program, it's very easy. There is a form that you can fill. I can drop that on the chat box. But let's see. So now this is some of our services here. When you go to jexcryptoexchange.com, I'm going to drop this on the chat box. Yeah. Okay. So when you go to this justcryptoexchange.com, one of our services is the crypto/fiat education. Okay, so these are some of the topics that we believe that beginners need to have, because you need to have this knowledge before you actually go in depth. Okay, so we have a short course program from week 1 to week 4. Okay. The first thing we'll talk about is the history of money. We go in depth. Okay. Then we look at investment opportunities in the crypto space. That's why we teach you about market evaluation, how to evaluate each project and see if it's actually worth a penny of your dollar. All right. So the advantages of crypto over fiat system, some of us already know that, but there's still a whole lot of advantages for newbies who are yet to figure out why the crypto space is more preferable than what we currently have now. So, and also the relationship between cryptocurrencies and blockchain. Some people still don't understand the architecture. They still don't understand what happens behind the scene. Why is cryptography what is the essence of cryptography in this entire space? So that's when we look into that. Then here in week 2, we look at how you can make short-term, mid-term, and long-term, investment in the crypto space. Okay, and we'll also walk you through on how to create secured wallets, various secured wallets, how to use external wallets, to actually save your cryptocurrency. For beginners, these are purely for newbies, and how to set up secured accounts in numerous cryptocurrency exchanges. We guide you to open your account and make sure you do your KYC properly before you start trading. That is if you're using a public exchange. And we also go deeper in week 3 when we start to talk about the trading aspect. For our trading aspect, we take you through, first of all, we'll give you the introduction to Forex trading. We show you how trading began, because what we are seeing here, everything that we've been talking here, when you go to the Forex market, for instance, if you're using the MT4, for instance, there are some other tools that can help you understand chart analysis properly, unlike what we have here on the exchange, on the crypto exchange, because it all started there. If you can master the technical analysis on the Forex markets, you can do very well on the crypto market in terms of technical analysis. So that's what we'll do. We'll take you back and kind of show you how it all works. Okay. So we show you some techniques and also some other profitable technical analysis that you can use, more than what we just explained here. Now, we also take you into Ethereum. Ethereum is a world of its own, okay, and decentralized applications, smart contracts, and also DeFi, which is also taking taking the space. So in week 4, we'll talk about social engineering related attacks, how you can stay off such attacks, and also how you can identify scams. Lately, we've seen a whole lot of Ponzi schemes, collecting our monies to actually do this thing that we're just talking about. This is what they use most of your monies to do. They just take advantage of the lows and the highs. Some also engage in arbitrage trading. We teach arbitrage trading in week 3 as well. Okay, you can buy in Binance and go sell it in Poloniex. The price difference is your profit. So this is what they do with your money. For those who trade, this is what they do with your money. They use it to take advantage of these highs and lows on these big exchanges. Binance is one of those big exchanges where they do that. So if you can trade and some company is trading for you, what they do is that they spend their time for those who trade, not those who don't trade. Those who don't trade, they just rob Peter and pay Paul and wait for another Peter to come to rob him and pay the next. But those who trade, this is what they do. They take advantage of these highs and lows. So you can actually use your funds and do the same at the comfort of your home. All right. If you make 10%, if you make 20%, your capital is safe. You can decide to do whatever you want with your money. For me, I think that is safe. And with my experience with many Ponzi schemes, I decided to pay attention to my own trading, and it has helped me over the years. So I'm now taking time to share this knowledge to so many people who have been victims of those Ponzi's. Okay. So also we teach you how to predict the future price of any cryptocurrency using daily trade volume, circulating supply, and market capitalization. So we believe that as a newbie, if you can master everything here from week 1 to week 4, you should be able to get started in the crypto space. Then we have an advanced course, which is for those who intend to become blockchain developers and the rest of them. That is when you go into behind the scenes of what happens, the creation of the hash functions and all those. But this is practically the first level of our training. So, and if you want to enroll, simply click here to join and fill this form in a very simple form, very simple questionnaire. You just indicate when you intend to begin, your full name, your phone number, your country of residence, just to have your details. You indicate if you already have previous knowledge so that we can know how to, take care of your part of the training. And this training is self-paced. Like even if you work, you can create a particular time when you're free and also enroll and begin your trading journey. I'm going to drop the link here so you can click on it and fill the form. You can also drop your phone number if you like, or you drop your email address on the chat box. If you want to enroll, we're going to take it from there, and or better still, just click on the form and fill it. So this is what we have for today. And to round up, someone asked if Bitcoin or Ethereum price is going to go up. That's a whole lot of analysis we need to do. Let's round up with that and see if is there any question so far? Any question? Any question? If there's any question, you can drop it on the chat box. We are still in question time. Feel free, drop your questions. And let's go to the Bitcoin market and see something. BTC. Okay, so let's look at the Bitcoin market. Based on what we've talked about, is the price of Bitcoin going to go up or is it going to continue going down? Well, based on everything we've talked about, you can see a market, you can see the bridge. The market has just tested the bridge here. How many of us can see that? If you can see that, can you just type on the chat box? Can you see the bridge? The market has just tested the bridge. If you can see this bridge, can you type on the chat box, the green bridge? Can you see the bridge? Good. The markets have just tested the bridge. It kissed it and kind of pushed down. So we are on the 4-hour time frame. If the next 4-hour candle comes up and breaks this bridge and stands at this point, forget it. We're going up. We're going back up to 58,000. Okay? But if the next 4-hour candle begins to struggle to break this particular bridge, you see, after breaking this bridge, definitely one thing you must know is this. It is very, very possible, because this bridge has been broken, You see, this bridge has actually been broken, just that the market is still below it. There's every possibility that the next candle that will come will break forth of this bridge. And once the market stays here, it's going to be very difficult for it to come down here again. So what you're going to have is a strong bullish trend that's going to break through all these other resistance. And if it breaks through this resistance and sits on top of here, then $60,000 BTC is in sight in a few days. So what happens to this 4-hour candle between now and the next 8 hours from now will determine what the price of Bitcoin will do. If it struggles to break this bridge, then it means the downtrend is still on. Okay, but if it breaks through this bridge and sits on top of it, sits comfortably on the bridge, if the market sits comfortably on this bridge, I mean the next 2-3 candles of the 4-hour time frame, if it sits comfortably on this bridge, there is every possibility that the market is going back up. So that is what you have to look out for. All right, so I think that settles that. Yeah, good. Yes, that's the support line, please. Yes, the bridge, that's the support line. So keep your eyes on the 4-hour candle on the Bitcoin USDT and see what happens in the next 4-hour candle and also the next one. So 8 hours from now is a very important hour, in determining what direction the Bitcoin market will go. Okay. So I want to, since there is no more question, I think we should call it a day at this point. And I thank you for your time. And we hope to have this kind of session, once in a while, to actually enlighten us on other things we need to know in the crypto space. In the absence of questions, I want to say thank you.
Thank you, Sam, for conducting this Zoom trading session for all of us in Singapore and some of you in Ghana. And thank you guys for making it down and supporting Sam on the Zoom.
Thank you so much. Thank you. We hope to, have this session again anytime soon. Thank you, everybody. Bye-bye.
Okay, just drop your link on the chat next time and take care. See you guys. Bye.
Bye.